Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
And welcome back to another episode of the Defence Property Podcast. Last week we were talking about the 7 must-check items before your next property purchase. Hopefully there were some really good takeaways to the audience in that one. And we thought we'd back it up with a sort of not a series but another episode that can be relatable. So what's on the agenda today, Nadia?
Yeah, so we've got the biggest property investing myths in Australia and why they persist.
Nice.
So if property investing was simple, I guess most people, everyone would be wealthy and that by now. Yeah.
Yeah, nice. So kind of property myths here, like we're talking about the barbecue mafia,
You like saying that.
Oh, I love the barbecue mafia.
I do like that.
But it's so true. Like, Uncle Bob and Aunt Jenny, they're a nurse and electrician giving property advice.
Yeah.
It's kind of like, a property investor coming around to my house and me giving them electrical advice on how to rewire their.
Yeah, it doesn't matter if it's property or healthcare or.
Yeah. I don't know the first thing about plumbing, but just because I fluked and unclogged the toilet one day doesn't make me a plumber or licensed to give plumbing advice. So we shouldn't be listening to, Uncle Bob and Aunt Jenny for our property advice. And, let's face it, since 2019, 2020, through the debasement of that fiat currency that we spoke about in the past, is just the purchasing power of the dollar has lost a lot of value, which has artificially sort of lifted a lot of prices around Australia. But they're still picking the right markets, as we spoke about last week, to get better performance. But a lot of Uncle Bob and Aunt Jenny's that have purchased their property 4, 5, 6 years ago have made a lot of money, but they probably lived in that property. So they didn't pick the market, based on good solid fundamentals. They picked the market on their emotional bias of where they want to live or where they do live, and they just had a good lucky entry to that market. But it certainly doesn't qualify them to give good advice. So the problem here isn't, the lack of information. The problem's there's bad information that sounds convincing, and this comes to, property groups and stuff when they're taking undisclosed commissions from developers and stuff. They can make some very convincing arguments, but really there's no quality advice because they're actually representing someone else in the transaction and not acting in the buyer's best interest because they're getting remunerated by someone else. So really understand, the property sprinkler group and stuff, or Uncle Bob and Aunt Jenny, understanding the motives of the people giving the advice versus is someone actually engaged on a flat fee for service to represent you through that process. So in this episode, we're going to break down the biggest property investing myths in Australia, where they come from, why they persist, what you should be focusing on instead. And this is for the people that actually want to build, a property portfolio based on good fundamentals.
So number one.
Myth one. What do we got?
You make money when you buy.
Yeah, so it's a bit of a myth here that this phrase gets repeated constantly, and it's half true, I would say. So yes, buying well matters, but you don't realise anything until the market moves. So it doesn't matter if you buy well in a bad market. There's probably a bigger problem that yes, you bought well, but you brought in a bad market. So that's where the half true comes from. Or the asset's not held long enough. So you've got to give the market time to breathe and move. Property is quite an expensive, lethargic asset to buy into. We've got stamp duty, capital gains, sales agent fees. It's quite a high amount of transactional costs. So we want to hold it for a long period of time and let the market do the heavy lifting. It's about buying in that right market. So many investors buy well, but they might sell too early, for example, or they buy well in the wrong market that I mentioned. They might over leverage, so like we touched on last week, cash flow is oxygen for our portfolio. If you've over leveraged, obviously your cash flow is not as good. So if someone's borrowing using equity, they bought their home a few years ago. They've got a really strong equity position. They decide to buy an investment. It's very common to buy 105%. And in most cases, that's correct when buying an investment property, so we can reduce debt on our own occupier. But if buying 105%, you're leveraged higher, the cash flow is not as pretty as it would be with a 20% cash deposit, for example, buying an investment property, because you're going in with a smaller loan, so the cash flow would be better. So just understanding that, buying the wrong asset in the wrong market, things like house and land packages, relying on depreciation and things like that. So, the reality is that you make money through time, compounding, holding a good asset in a good market, not just negotiating on the way in.
Yeah. So that time in the market is probably priority and not, timing.
Well, we want to time our entry to the right market, pick the right market, but time in the market and holding it long periods of time.
Yeah. Okay. So myth 2, capital growth is everything.
Yes, capital growth is everything. So capital growth is so important. That's why we're buying investment properties. Capital growth is what is actually going to make us wealthy. But growth without control is quite dangerous. So chasing growth alone can have some flaws in it. So, for example, high-priced assets. If a property is 1.5 million, generally the higher in price point we go, the lower that yield is. So the yield won't quite keep up with it. So we want to be buying in those medium prices, that affordable range for the masses. Think of the center of the bell curve. That's where we're going to have good growth, but also a little bit better yield. So, that poor yielding asset is really going to hold us back. And then we can't expand the portfolio to get more growth on the portfolio. So understanding our serviceability, which is going to impact our ability to buy again and again as we try and build and scale our portfolio. So capital growth should be our number one focus, but it's not everything. There's so much more to consider. What does that actually mean? So growth relative to yield needs to be considered. Cash flow sustainable and borrowing capacity over time, thinking about our second and our third purchase when we're making the first.
Yeah, okay. So slightly lower growth asset. Okay. So you'll be able to buy like 2 or 3 instead of just one big one. It's not.
Yeah, so it comes back to that strategy piece, not just buying one property and maxing yourself out in that first purchase, but having a strategy and a plan in place to build and scale your portfolio. Now, a high income earner, whether they're successful, maybe self-employed, they've got a good business turning over, it may make sense for them that have high income levels, and having a highly negative geared asset would, they don't want to be their time poor. They don't want to manage
2 or 3,
10 properties at $600,000 each. They might just say, let's get 3 $1.5 million assets. We know the yield is going to be lower, but I'm time poor. I've got the cash flow to support it, and we're going to get growth. So, but then someone on a more modest income, everyday PAYG, buying more median style priced assets with a little bit stronger yields is going to be a better portfolio fit for that person. So it's just understanding, does the market and the property fit the strategy for the client?
Yeah. So myth 3, negative gearing makes a bad property good.
Yeah. So
you're going to get all that money at tax time.
Yeah.
Are you going to go spend it on something?
That's right. So if you got to feed it back into the portfolio, I guess, is that initially, but tax outcome should never be your primary motive for what it should just be an auxiliary benefit of being a property investor. Negative gearing is an outcome, not a strategy. So it doesn't fix a bad location. It doesn't fix a bad property. It doesn't offset weak demand or anything. It won't compensate for a saturation of oversupply. It doesn't magically improve performance. It's just an auxiliary benefit that exists on the property. And it's key to understand that you do pay that depreciation back when you sell the property through an adjustment in the cost base of the property. So if you're not unsure of that, speak to your tax advisor or accountant and really just strategize. If you're planning on selling the property over, in 5 years, 10 years, I'm just understanding that depreciation will get added back. A loss is a loss. You know, and that's the reason it's a tax deduction. The ATO, then the Australian Taxation Office, acknowledge that your property is losing value, so they allow you to claim that loss as a tax deduction. You are losing money and just claiming that loss back, right? So it's much better to be buying a good asset in a good market, and the depreciation on that asset is what it is. That's right. Yeah.
So buy a property that works, not based on what you're going to get back at tax time. Yeah. It's just a little benefit,
It's got to be a good fit for the portfolio before any tax consideration. Yeah. You know. So obviously if you're getting a loan, the interest is tax deductible. Yeah. You know, rates, insurance, everything like that. There's still tax benefits beyond just depreciation. Yeah. But don't be sold that this is a good investment because it's got a high amount of depreciation.
When we're looking for properties, the sales agents always like, it's got a really good yield and great depreciation and that. They always use it as a bit of a selling point. But so myth 4, new properties are safer and better investments, newer versus older.
Yeah, new properties are often sold as, you know, low maintenance. It's important to acknowledge it's like buying a brand new car. You lose value the minute you drive it off the showroom floor, that new property. Hence, it's new and shiny, so it depreciates faster, then you lose money faster. So the ATO are acknowledging that. It's kind of like prepaying a lot of maintenance. You're buying it knowing you're going to lose money, or if you're educated and understand it. So, you know, you're much better like with a more established property and the maintenance, whether it's 20 years old or 2 years old, there's still maintenance to that property.
We know that,
but at least a 20-year-old property has lost all that shine and a lot of that depreciation has already been claimed.
Just because it's new, you still got to do that, like, you know, annual maintenance. I don't know, you know, clearing out gutters and air cons and things like the maintenance is still there.
Smoke alarms, you know, all your compliance checks.
Yeah. And they often you still have issues that you wouldn't expect because it is new, but
and new properties are often sold as low maintenance, high depreciation, set and forget, because they're being sold on those metrics, not because they're good investment decisions, because the person selling you those properties is receiving that undisclosed commission from the developer. But in reality, many new builds suffer from many issues, you know, developer margins baked into pricing, undisclosed commissions and kickbacks, you know, paid to property groups, oversupply risks, inferior land to asset ratio. So when we're talking about land asset to ratio budget, like how much of our $1 million budget is the dwelling price? You know, because that dwelling is depreciating or losing value. So if it's 70% of our budget is the build and 30% of our budget is the land, you know, it's 30% of our $1 million spend is actually losing value versus buying a more established property in a market that's fully built out with no new supply. We might be spending $1 million, but 70% of that $1 million is land value versus 30% because it's got an older dwelling on it. 30% of our budget then is the dwelling that depreciates, and 70% is the land component that is what appreciates in value. I'd much prefer to hold a vacant block of land in Bondi Beach than a brand new house out in Greater Western Sydney, because one's got far superior supply and demand metrics.
Yeah. So newer isn't necessarily better because it's, you know, we appreciate the fact that scarcity is going to you know, help the long-term growth, land 100%. Values and the location. It's not about the age because eventually that new house gets old.
Correct. One day that brand new house is, and you can make the argument the minute you buy it, if it's brand new, it's not brand new anymore. Same as a car.
As soon as the tenant goes in.
You drive it off the showroom floor. As soon as the tenant goes in, it's an investment property and it's secondhand. Yeah. You know, so you're just the one that's paying that premium to drive that house off the showroom floor, I guess.
Let's go. Myth 5, you should only invest where you live.
Yeah, this one's a big mistake, I feel, and probably the number one mistake when buying an investment property. Reverting back to 22-year-old Kane, bought his first property in an area that I was posted to as a young soldier and didn't grow in value for 15 years. Other areas in all of Australia, you know, doubled in that same period of time. So market selection is critical, going beyond our backyard. People often say, I know the area, it feels safer to invest where I know I can drive past it and see it. I can carry out maintenance on the property, but people then realise they might be an accountant or a nurse or an admin position or a project manager, and they realise that they don't know how to change the hinges on the cabinetry in the kitchen, or they don't know how to unblock the toilet. So just because you can drive to it doesn't mean you can carry out the maintenance on it.
Yeah.
And most people end up just, even if they buy in the area that they live, they get the tradies through the property manager to carry out the maintenance. So it's a flawed assessment, but it makes people comfortable.
A good property manager with good trades is more priority than having it close to you to do your own maintenance.
Because you're never doing the maintenance yourself anyway. And the trade-off that you're talking about is potentially tens of thousands of capital growth performance to save a couple of $100 on, if you can.
Sealant.
Some sealant or some tap washers or whatnot.
Yeah.
So, but your local market could be overpriced, for example. It could be late stage cycle, not suit your strategy. Like, you could have brought your own occupier a long time ago and it could be worth 1.3, 1.4, 1.5 million. But buying an investment property there, if you've only got a small allocation of surplus cash flow to hold an investment, it might not be suitable. So really understanding that the market you're buying got to be positioned through supply and demand dynamics for growth, but also portfolio fit. So buying in your backyard doesn't necessarily mean either of those.
So everyone, it should be property is on a national basis and needs to fit your strategy. And it doesn't,
The best investors that get the best results get out of their comfort zone. Yeah. Comfort zone is their backyard, but you got to get out of your comfort zone to get the best performance. And the most successful investors are using data assessment, cycle timing, not buying in postcodes they're familiar with.
All right. What about if property is passive?
It's just not. Property investing, you have to manage a tenant, you have to manage like maintenance, you have to manage your loan. There is an element of management. Yes, it can be long-term sort of set and forget, but you still need to manage it and be involved in it. It requires strategic planning, finance management. So you got a loan, you got to be familiar with your finance, your cash flow, doing things like projecting your cash flow as well. When in the future is actually going to turn from negative to neutral to positive. And you can project that out using some long-term averages. You can be conservative in your projections. You can be long-term average, or you can be aggressive depending on your market selection. You got to manage a tenant and tenant turnover. You got to manage your property manager. Is the property manager performing? There's some real horror stories out there of having the wrong property manager in place.
I get worried when you just haven't heard anything at all.
It's so hard. Like there's an argument that no news is good news, but there's also, you do need to know, and that's where the managing your property manager comes into it, that you need to know what's going on with your investment. It's obviously you've got a loan, a lot of money invested in this investment property. Just putting your fingers in your ears and turning a blind eye, leaving it to the property manager. I know looking back many years ago, we had a property and I noticed there was a variance on the rental statement once. Oh, what's this? Why is the rent so low? Called them up. The tenant had moved out and the property manager hadn't even told us, hadn't advertised the property. They hadn't done exit. They had done nothing.
Yeah.
And it was because there was the turnover of staff in that property management business that it had just gone through to the keeper and everyone had missed it. So it's so important to have a good property manager that's actually got the finger on the pulse. And when you look at property management as an industry, it's such a hard role to find good staff for businesses. You're the meat in the shit sandwich. Doesn't matter how thick the crust is, how white the bread is. That property manager, generally they're not receiving positive phone calls from their landlord or their tenant. They're receiving a phone call from the landlord or the tenant when something's gone wrong and they're not happy. So
I think if you think it is passive and you just out of sight, out of mind, and that's probably a bit of a mistake, and you'll just end up disappointed, I guess. Yeah. Because we, took our eye off it and look what happened. The tenant moved out, no one even told us. So, yeah, I think
and
that's
a good
you've got to
property
be across
management business today is not necessarily the right one in 6 months because, as I was saying, property management that as an industry is that they do have a high turnover of staff. I guess that is quite stressful being a property manager, getting lots of negative phone calls from landlords and tenants and managing 80, 100, 200 properties a month. So the right business today is not necessarily the right property manager for you if they've had turnover in staff.
Yeah.
And property managements get sold all sorts. So,
Yeah.
it can be very passive and set and forget property, but you've got to still have an element of management of your portfolio because ultimately the responsibility falls down to you, the investor. You're the one that took the loan out. You're the one that brought the property. So it is in your invested interest to
That's it.
to
You just
manage your
disappoint
team.
yourself.
Yeah.
Yeah. So myth 7, once you've bought one property, the rest is easy.
Yeah. So, the challenge comes with the second and the third purchase, making sure they fit our portfolio, managing, when we buy our first, we want to buy it with the intent of how do we access our second and our third. So there's so many considerations to serviceability constraints. If you've got 1 or 2 properties and you're a young soldier, sailor, airman, that's great because the positive thing with defence is you can have a fairly clear and defined progression of promotion, which comes with promotion salary increases. So understanding those, plan that out if you like, and you can plan it out in alignment with the growth of your portfolio. Each time you make a Lance Corporal, Corporal Sergeant, Warrant Officer, you can plan I want to add 1 property each promotion I get and grow your portfolio with your career. An important one there though is, I guess, lifestyle creep, which comes into the finance side of things.
Yeah.
So once we get that promotion, don't absorb all that new $5,000, $10,000, $15,000 additional income into lifestyle. Allocate it according to your budget. 25% to living expenses, 25% to wants or spendings, 25% to bills, and just managing the additional income according to our budget. Many investors are stalled not because the property stopped working, but because there's no strategy and they didn't evolve with their portfolio. That asset selection, if you are on a tighter budget, making sure that you're selecting assets with, better yields versus assets with lower yields and higher price points. Purchasing in entities come into consideration here. And having the right accountant, broker and buyer's agent that can advise you about the pros and cons of purchasing an entity and when it's appropriate. There's a lot of, noise in the industry around buying in trust and creating an environment where we can preserve or stretch out some of our borrowing capacity, but there's lots of downsides to it. So having the right accountant and broker that understand that strategy is important. And just managing our portfolio. And this is kind of the active side of managing and growing a portfolio from it not being passive. Like you manage your property managers and tenants that we mentioned, but also managing the strategy and having the right sort of advisors on your team to help you guide you through the many different from tenant and property managers and debt strategy, asset selection strategy, that. So why these myths are important, like there's these myths stick around because, again, last week we touched on them, but media love a punchy headliner, but it's understanding, getting into the weeds of the myth and understanding its impacts. Success stories are always shared, but it's the unsuccess stories or the ones where it didn't work out, the one where it failed, that you don't hear about. And it's about having a plan and strategy in place to remove as many errors from the purchase along the way. Because, losses are never talked about. There's no, glory in getting out and putting yourself out there and telling the story about how it all went wrong.
Yeah. People want certainty and requires a bit of judgment and stuff. So
property requires judgment and that foresight and planning. So if you want to succeed in property, You must be willing to replace emotion with plan, strategy, process. Think in decades, not years. Many people often overestimate what they can achieve in 1 year, but underestimate what they can achieve in 5 or 10 years. And property investing is all about delayed gratification. It can feel quite cumbersome and like a hard slog in the early years of building a portfolio. And that's when, you're trying to get it off the ground. So you might initially buy your first one with a 5 or 10% deposit, and the minute you can get your second one, you buy it, but you're at 80% across the portfolio. It's not until you've had a few years in the property market where you've built the portfolio to maybe and let time do the heavy lifting to get you to 50, 60% LVR across 3 or 4 assets. And then you've got that relief, and you can, it's coming to fruition. And then, in the back end of the portfolio, you've really got a good degree of separation where inflation's eroded your debt, rents have, really increased since you've purchased them, and then she's humming.
Yeah. Very good.
So if this episode was helpful, and it's something that you believe you want to get into building a portfolio, and you want to get good advice and not take advice from that barbecue mafia, reach out, book in for a free discovery call. We'd love to speak with you. Thanks for following along, and we'll speak soon.
Thanks, Kane.